when the gold to SPX ratio starts turning in one favor or the other, and right now it's the SPX is about to start losing versus gold. Gold's about to start outperforming versus SPX on the like a long term time frame. Just that ratio chart, it looks exactly like the silver chart. So somebody's looking, say, oh, silver, when is it going to go up? It's not going up. Well, when the capital flows start leaving the U.S. equities and they start going into gold, then silver is going to go ballistic. The miners are going to go ballistic, because that's all that's missing right now. It's a true transition. And I think since 2018, 19, it takes years this stuff to play out. You can't look at like too close a time frame, but we're turning a corner right now. So once those capital flows, for whatever reason, inflation or all the macro tidal waves behind it, start going to gold instead of U.S. equities, man, like hold on to your miners, guys, or hold on to silver at least and the metals, because those are going to have long, strong, meaningful trends. This is the problem of silver. It went ballistic in the 1980s. It went ballistic in 2011, but for short periods of time. So when you're considering macro tidal waves, these short period of times, they're not that meaningful, right? Because they're on the end of the curve of like, you know, those bell curves, the statistics. There was a lot of fear of missing out. A lot of people talking about silver. But if you take a step back, that chart, I have the 16-year moving averages for gold and silver, and starting back at 1930 or something. And you see over time, these just been going up and up and up. And people saying, gold and silver, or at least silver's way below its 1980 peak or 2011 peak at $50. But look at that moving average. We're way higher than where we were in the 1980s. It's just this roadmap is just taking a long time to play out, guys. And I could have probably overlaid the money supply on top of that, or all the other financial instruments, to try to buy, not in fear of missing out when silver's at $50. It's to try to understand where it is in the landscape of the financial world. Like I said, the gold to SPX ratio. If we're at a turning point, and now we know with TA, technical analysis, that the opportunity cost is lower and lower because we're approaching an important major turning point. Yes, we could be off by 6 months, a year, but when you're talking about gold and silver, those are small time frames. If you're able to catch the turn, then if you're able to hold on, because that's another thing, there's just the volatility of silver is going to shoot up 100%. It's going to rip your face for 2, 3, 4 months. Then it's going to consolidate for 6 months, 8 months, 2 years, going sideways like we've had now. But if you get in early, you won't feel forced to sell when you have those drawdowns, right? It's the people who buy it, fear of missing out, that like the people who bought Bitcoin, let's say at 60,000. Now they're kind of trapped emotionally because Bitcoin goes down and they're hoping that it always keeps going up. But if they would have bought, like the TA was telling them to buy when, let's say Bitcoin was breaking out at 10,000, when Michael Saylor was not talking about Bitcoin, then you were creating, then when you have a pullback much higher up going down, you're less susceptible to sell because of, you're still in the profits, right? Understanding that silver is cheap, and even gold, where it is now today, it's still cheap, but silver is way more cheap than gold right now, relatively speaking, especially when you measure it versus gold or versus the SPX. Then when it goes ballistic to 50, 60, or $80 and it pulls back to 30 or 40, it's still much higher than what it is today. And that's how you're able to ride these lock steps, or these ladder steps through a bull run. You can't get in late. Look, if I don't know if CNBC would be touting silver today, I'd be doubtful, but look, I'm getting hate. I have so many trolls, Andrew, you can't even believe it on Twitter. It's crazy, but that means we're still at a good moment, that there's really nobody thinks, everybody thinks silver's going to crash. Everybody thinks gold is maybe, there's going to be deflation, inflation's transitory. You still hear these things out there, right? I try to find tools which are going to help me situate my emotions versus the reality. So the further you are away from a moving average, the more the emotion's high. And I could have probably put, here I have the gold chart, like where it's written minimal target 35.50. It's a cycle that restarted in 2003, and you should have loaded the boat. Long-term meaningful trend. These are the opportunities of once in a lifetime to buy in 2003 gold. And then again, you see it rolled up. It got stretched away from its 16-year moving average. And I put some circles where previously it hit some resistance. And what happened after that? A small blow off top, and then it went back in hibernation. But here's the new opportunity right now. We're creating higher lows on the distance from that 16-year moving average. And there's a clear pivot line or breakout line, where a pivot line in TA is lines, guys, is the most it gets tested from above or below. It becomes meaningful. The market's reacting to that line. So you got to pay attention to it. Look, we're right below it. So the bull run for gold has not even started. It's practically hasn't started, Andrew. It's crazy. The momentum's trying to carve out a higher low right here. And I'm pretty sure that once we close above that 71% above that 16-year moving average, we're going to have fireworks. Stackers, good for you. You're buying super cheap right now. And traders, if you had a chance to play this gold market, swing traders or position traders, look at that. When you're coiled close to that 16-year moving average, these opportunities, they don't happen that often, guys. They happen once here. Here we crossed above. In 2018, that was the last chance, the last greatest chance. And now we're having another opportunity for gold. So with gold, guys, you can't look at the daily chart, please. You'll get destroyed. The daily chart, hourly chart, gold is a long-term play. You have to spot these opportunities where there's a paradigm shift in behavior, where the US equities are underperforming, where hedge fund managers, they get punished by putting their money in stocks that are not doing well with inflation. They start going into gold, because if they don't, they'll just get punished for that whole cycle. And gold just keeps climbing up until it closes back below 3-year moving average. You hold on for dear life. And look, we just started a new cycle. It's crazy how I hear like, it's over. Like, guys, until you close back below the 3-year moving average, you got to let this dog run, man. The next time we have an explosion, we're probably going to shoot up all the way here to 31 or 3,300 or wherever it is, it lands. Then a lot of people are going to get in there. You're going to hearing about gold going to 10,000 when it's at 3. That's when you should say, okay, it's going to move sideways, guys. It's just going to reset naturally. And then we get ready for another move up. So, yeah, so for whatever happened here, gold did not really care about that event. Gold broke out in 2019 off something totally different. It's the inflation adjusted US dollar. It's reacting more to macro tidal waves that have been set 40 years ago, 50 years ago, since we went off the gold standard. And this is just playing out. So all these noises, even if there's a liquidity crunch right now, it's not going to worry me too much as long as gold stays above its 3-year moving average. A news event or something that happens in a bull run would have a tendency to resolve in the favor of the bull run.